Off a conversation about RWAs, or real-world assets. Are they the sexiest corner in DeFi? No. But they were bread and butter following the 2022 credit collapse. Think T-bills tokenized, getting picked up by crypto corporates and DAOs so that they can sit out crypto market risk. The situation now, though, is that there's a vibe shift. And the question that we're wrestling with today is, if they build it, will you all be there, even in a bull? Now let me introduce my esteemed panelists, starting all the way over there. That's Assad Khan from Centrifuge. Yeah, do it. Hype.
Brought my friends, thank you.
Next is Caladora, Kieran, and Lynn from Powosteum Labs. Justin Schmidt from Ando Finance. And of course, Sydney Powell from Maple. Caladora, what's your take on the situation, and what is Powosteum Labs doing to strategize for the bull?
So quickly to introduce what we're building Powosteum, which is real-world asset perpetuals, maybe also known as RWAs for degens. So I think we are uniquely positioned to sort of take the bull market in stride. Just to give you a little context, it's all synthetic, so we're not a tokenization protocol. It's all USDC settled. Looks and feels like your favorite perp stacks, but gives you price exposure to assets like WTI, natural gas, gold, silver, palladium, and even my favorite commodity, lean hogs. If you're familiar with those, they're skinny pigs, soon tradable on chain. So many of those assets are sort of highly correlated to, usually traded around sort of macro events. So for Forex specifically, people are often trading this around CPI prints or Fed announcements, rate changes. On a lot of the energy, sort of the rationale behind listing these is due to a lot of the sort of geopolitical events occurring recently, sort of increased interest in energy trading. And then there are plenty of more memeable commodities, lean hogs among them. I'm not sure if you guys are on crypto Twitter when frozen concentrated orange juice was pumping. That's another interesting one. So yeah, I guess maybe to answer your question, we are uniquely positioned in that we are catered towards traders, not towards long-term holders. And so we are dealing with assets that maybe are less sexy in a bull market, but we have the ability to sort of respond to demand and what's in the meta and list things that are a little bit longer tail and more exciting in a way that hasn't been done before, and people have really nowhere else to access these assets. Certainly on chain and even off chain, the ability to access these assets is pretty limited due to constraints around like fractionalization and some other stuff. But I'll turn it over to any of the other panelists.
Well, Sydney, you do some institutional lending. I'm curious to know, like, what's the word on the ground over at your shop?
Institutional lending's definitely picking up again. So I think if we look at 2023, there was a lot of focus on low-risk assets, so T-bills, investment grade assets, higher yielding, shorter payback periods when it came to private credit. What we've seen this year, though, is a shift where people are going more risk on. So I consistently see that corporate treasuries, DAOs, want to get T-bill exposure on chain because it's low risk, very liquid. They just have to, concern themselves with payroll and runway. But hedge funds, family offices, and kind of your ultra high net worth are now looking at more risk on assets. So we're seeing in the real world asset space appetite for like private credit, but in the regular on-chain credit and yield space, appetite for altcoin lending, for even still early days, but things like NFT lending are starting to show pricing increases. So what I would say is if you're looking at the market as an investor, what we're seeing is a broadly risk-on appetite from your crypto-native institutions, so hedge funds. We're still a ways away from seeing traditional Wall Street institutions coming in and buying these assets, but it does indicate that we're kind of the early stages of a new bull market.
Assad, do you have thoughts?
Yeah, I mean, I think in the last cycle we learned a lot about. I think everyone learned a lot about what it is actually to have low risk assets, diversified assets, uncorrelated assets, and so I think that kind of sentiment will be there even despite what happens with risk sentiment or rates. T-bills have a role to play in everybody's portfolio. I think is kind of the safe way of saying it. So I think that there's always going to be interest in low risk principal assets. I think real world assets can kind of fit that bill pretty safely. There's nothing more liquid than T-bills and investment grade credit. So I think we'll see that kind of continue to play out, but I definitely think Sid's right. Like the interest and appetite is coming back. I mean, Calidora is talking about meme RWA. Like that's a pretty bullish signal in my opinion if we're getting there in the market, right?
There are more than one interesting venues to talk about. Ando Finance had some, jaw-dropping news yesterday. Justin, do you want to talk about it a little bit?
Sure, yeah. And I guess thanks everybody for coming on a Friday afternoon. It's actually good to see people in the crowd. Yeah, so just for those who are not familiar, Ando Finance is, our mission really is to build a tokenized financial services firm of the future. We very much believe that TradFi and DeFi are emerging over time. We started with tokenized money-like assets, so like T-bills and money market funds. And importantly, we also think that in addition to building the tokenized assets, you actually have to help develop and build the on-chain protocols as well, and that the two actually have to dovetail nicely together. That said, I think the world of real-world assets, in particular, less so the less so the commodity side, more so the security side of the world, it's not entirely clear that you need necessarily all of the benefits that like a blockchain may give you, say 24/7 settlement. Like I don't think it's particularly clear that you need to settle your NVIDIA stock on a Sunday afternoon or anything like that. So we announced something called Ando Global Markets or Ando GM. And the point there really is to think about what it takes to bring the next 1,000 public liquid securities on chain in a fashion that actually makes them compatible with these DeFi protocols. And I think the major real unlock here is that we have a pretty opinionated rethink of what tokenization means. This is a developer conference, so I'm going to sort of use some developer analogies. I kind of think of it like we are connecting API keys where you're interacting with a broker-dealer to actual smart contracts. And one way we want to do this is basically thinking about fractionalizing your API key and allowing that via assets actually held at a broker-dealer to interface with the cool different DeFi machinery that people in this room, people in this panel are making.
I have like an inkling that might help solve crypto's credit problem, which is a real thing, but I'll, hold to see how it plays out.
I can see things like that being used for, collateral on loans. So you might not necessarily want to settle your NVIDIA stock on a Sunday, but you might want to post it as collateral to borrow at short notice. And so I think bringing these assets on chain allows ultimately credit expansion, which also helps reduce the correlation the correlation that on-chain activity has with the price of Bitcoin and ETH. Because we're all very constrained by that at the moment, but the more real-world assets come on chain, the less constrained we are, the more credit we can do, or lending activity that you can do ultimately.
How do you think about like what assets to choose to bring on chain and when?
I think two things. There's got to be the demand for the asset. So think about an asset that people can't easily locate and use elsewhere. This is one of the reasons I think real estate has struggled to come on chain in a big way, because it's very efficiently priced already, and there's an abundance of it elsewhere in traditional financial markets. So if you think of things that are kind of niche, that aren't as easy to get, then you have an advantage, because you're doing it on chain is going to be less efficient to begin with. And so you're not getting penalized as much for that inefficiency when it's an asset that isn't easily available elsewhere. And then the other thing, though, is you do want it to be something that can actually scale. It's no good if you bring an asset on chain and you can only do 1 million of it. Better if you can bring it on chain and do 50 or 100 million of it. There doesn't need to be 10 billion of it, though, because our market's not that large. So you want something where you can scale it so that you've still got a business, but where there's also a real customer need. Otherwise, this has been the problem that a lot of RWA initiatives have had, is that it's just pushing assets on chain without anyone clearly wanting to buy them.
Yeah, just to add to that though, I do think that the long-term, like holy grail for all of us is still kind of the inaccessible markets and access for credits that just haven't been able to come to mainstream markets as easily, right? So private credit for me is like the best representation of that. It trades over the counter, it's largely opaque, it's pretty difficult to kind of access unless you're a certain type of investor. You can start to use all of the benefits of blockchains and stable coins and kind of new financial infrastructure. You can build transparency to your portfolios. You can, on the issuer side, you can build structured credit in a really interesting and efficient way. But that's like the hard stuff that takes the right mix of demand that like Sid is talking about, but also can leverage kind of blockchain, I think, in an interesting way. And it ultimately, at the end of the day, it is about really improving credit access for businesses and investors alike, right?
Yeah, on the other side, I can sort of see how that works for TradFi as well. Sort of how like secondary trading actually improves transparency and gives investors more information. So thinking about that though, I mean, what y'all are doing, Wall Street also wants to do, and they're working on it. But can y'all do it better? And why do you think that's the case? For anyone.
I wanted to maybe just add on to what Assad was saying and answer your question around how you pick assets. I think there's two main things that we think about. One is like what is in the meta, and I alluded to this earlier, but what I think maybe drawing an analogy to on-chain perp dexes that have done very well in the last 6 months. One strategy that has really distinguished dexes has been the ability to quickly list assets that are sort of in the crypto meta. You've seen this with, for instance, like pre-launch futures or index tokens on things like Friendtech. I think these are this sort of strategy is great at capturing mind share and capitalizing on what people want to trade at that moment. And so we think about this sort of in an analogous way in the sense that when there's a lot of interest, OPEC cuts supply, there's a lot of interest in trading oil, we would basically tap into that. And there's obviously like the large caps, G10 Forex, large commodities that we would list by default. But as we think about which ones we would list down the line, I think of sort of like macro, there's like crypto Twitter and there's like macro Twitter, and there's a little bit of like filtering in. And I think increasingly, as also a lot of these assets get listed on chain, and as the traditional markets and the on-chain markets start to become more and more blended, the things that are in the macro meta will increasingly be in the crypto meta as well. So we see basically capitalizing on what sort of is in the macro meta and trickling into crypto and listing those things. I think the second component, which is a little bit less short-term and more around market structure, is specifically within commodities. And this is actually originally where the idea to build Ostium came from, and what made us really excited about it was commodities are quite difficult to access for most investors and have a lot of unique features that differentiate them from securities like treasuries or equities and so forth. And I think commodities are going to be one of the most difficult things to tokenize, hence why actually listing them in a synthetic fashion with all USDC settlement and effectively virtual exposure is what we would call it, is a sort of the most viable near and medium term solution. And just to give you an example of that, WTI, for instance, there are between 12 and 15 different contract expiries that are open at any given time, and there is no, obvious linear decay over, where the most open interest or the most volume is. So there may be a lot of volume or OI on the March contract, and like more as the expiry nears, more on the April contract. But that doesn't mean that it, linearly decays over time. For instance, there will be often more OI on the December 2024 expiry contract than on the one that expires in, say, June or July, because of just the dynamics of traditional commodity or like actual commodity producers or traders that need to do physical settlement and how that impacts where they need to hedge themselves. So maybe to conclude, I think commodities are a unique asset class that they're quite difficult to tokenize. There's not just like one you don't know precisely which contract you should be tokenizing. It'll roll over, it'll expire. I think they're uniquely suited towards being listed in this sort of synthetic fashion. And then there's the meta portion. But anyways, turn it over to someone else.
And see, I think institutions will want this type of stuff on chain, right? And I think, to your question about are the institutions coming, will they come, why aren't they here right now? I mean, I'm so bearish that we'll ever see them doing this type of stuff. It's so hard to build on-chain DeFi structures. Everyone here knows it. And then integrate real credit, real assets, real commodities, whatever it is. I mean, our lives would be easier if BlackRock brought their liquidity on chain, but they're so far from doing that. Like, I just don't think that future is ever going to be there.
Must we rely on BlackRock for everything?
Exactly. We can build it ourselves.
I think ultimately none of us want those bigger players to kind of come and compete with us.
Why is that?
Well, because then it hurts our businesses. But less prosaically, I think the issue is this, a lot of people might have heard of it, the innovator's dilemma, but a lot of these companies are set up in such a way that they have a core business, and you particularly see it for some of these big trading firms where they started a crypto team or a desk within, and then end of the last bull market, they shut it down because this tiny little revenue producer was a massive reputational risk for the core business. And I think that's why they will struggle to compete, because they're not solely focused on building this on-chain business line, which all of us on this stage and everyone at this conference is kind of motivated by. And so their marketing team, their sales team, their tech structure, none of that is set up to deliver this product in a way that our customers and our users want to access it. This is one of the reasons that General Motors and the conventional car companies are not the most successful electric car companies today. And I think we should expect to see that same pattern play out in financial products and DeFi.
What do you think, Justin? You were just there.
I guess I have a pretty different take. I think that almost all these major institutions have been watching this with laser-like focus for a very long time. There are a lot of very smart people in these firms that very much would like to do more than they do, but they are also going to be much slower movers than those of us on chain. I very much welcome all of that. I think we've all seen the positive benefit that BlackRock and Fidelity and others have brought to the ecosystem with their effectively opening up their distribution networks to a way for their clients to buy Bitcoin in the trusted way that appeals to them. So that market access of the enormous amount of capital that is beyond the on-chain universe of capital, I think is tremendous. I do think where the incumbents will struggle is that innovation is not as simple as lift and drop my old thing onto new rails. I think if you are trying to do something in this new world, you have to sort of ask and be very ruthlessly honest with yourself, what really is so bad about the traditional financial rails? There are some examples, right? Different countries have different rails, different asset classes have different rails, and wouldn't it be nice if everything was on the same rail, et cetera? And I think that's where we're going with all this. That's why a lot of the people are so excited about tokenization. But if you just tokenize something and then don't do anything with the token, what's the point, right? I think a lot of us here are very keen on actual utility of the tokens. Sid makes a great point about collateral. I think that's a tremendously important part of where we're going with all this. I think the biggest challenge for the institutions is not whether they're going to get here. I think they eventually will. I do think it's going to take some time, for sure. But I do think that when they come, it's going to be a large positive effect on the industry. I welcome that with open arms, and we work with a lot of the largest institutions in the world. We learn from them. Hopefully, they're learning from us. But I do think they have to do a pretty deep think about what that thing looks like. So I think one example of this, very briefly, is our version of a money market fund is very different than a traditional money market fund. We have it in token form, where the token actually, you basically get new tokens every single day. It looks much more like a crypto native version of a money market fund rather than just a traditional one that you lift and drop on chain. So I think there's very much making sure that if you're out there from a traditional financial institution, make sure you're building something in the right way for where all this is going.
I get it. Well, we don't have that much more time till happy hour. So I guess my question is, what is your outlook for RWAs this year? Do you want to just go down the line, starting with Assad?
Yeah, sure. I think we'll see a lot more on-chain capital coming into real-world assets, especially as utility gets built out. I think that'll be the big theme towards the end of this year. And when Bitcoin hits $1 million, I think all those high net worths and whales will be investing.
Echo your sentiment. I think everyone in the RWA space is well positioned in the sense that more capital flowing on chain during a bull market is always beneficial. Rising tide lifts all boats. Even if there's, on a relative basis, there might be more hype around more deeply crypto native stuff. Positive outlook.
Yeah, I think we've transcended when Bitcoin itself is a real world asset. But Yeah, and I think I'm incredibly bullish, right? I think there's just tremendous energy, tremendous smart people working on this, tackling all different types of real-world assets, from stablecoins that are more currency-like to commodity-like to security-like. It's I think, very, very, very optimistic for the future here.
I'll take the under. I think you'll see more of the really conservative ones, so T-bills on-chain and the lower risk instruments. But I think at the higher risk spectrum, people are trying to get that from on-chain assets. So I actually expect to see RWAs continue to grow slowly, but the on-chain risky stuff will take off a bit faster this year.
You heard it here first. You know what we live for? RWAs, but also applause. So can we have some?
All right. Thank you. Thank you. Speaking of things you heard here first, a little